Section 121 exclusion is if you live in a primary residence for at least 2 years in a 5-year span, you can sell that home. If you're single, you can exclude the first $250,000 of capital gains from that sale. And if you're married filing jointly, you can exclude the first $500,000 of capital gains from that sale. So it's pretty sweet. It's a great way for people to, not only get their primary residence, but as they build equity, that's going to be tax-free equity. I know some people who they'll take advantage of this. They'll literally try to buy a home every few years, sell it in hopes that it appreciates in value. They just capture that tax-free income. Now, there are a few things with the Section 121 exclusion that you have to keep out, right? So what a lot of people will do, let's just say they have a home and they're like, oh, we want to take advantage of the Section 121. We want to rent it out for a few years because we get 5 years to do this, right? We lived in it for 2, we get 5 years. So they live in it for 2 and they'll try to rent it out for 3 years. Well, depreciation is a mandatory expense. And what a lot of people will quickly overlook is the fact that depreciation recapture does not apply to the Section 121 exclusion, right? So they'll have this capital gain and they'll think the entire thing is going to be excluded from their income. However, that depreciation recapture doesn't fall under Section 121, so then they end up still having a little bit of a gain, right? So you got to always play the field. The good thing about that is that, if you have any losses from that property, whenever you sell that property, those losses, the passive losses, get released and they can help offset your gains. So there's always something that you can look into.